Alright guys, today let us talk about liquidity. So today I'm going to be talking especially on liquidity, and because liquidity is a broad course, I'm going to make this video in like a series format where I'll talk about introduction of liquidity, then identifying and understanding the types of liquidity, then the last part is how to know a mitigated liquidity area. So that's the three things I'll be talking about in this very video, not this particular video, in this very topic, but in a series. Like, it's gonna have a playlist in my channel here where you can watch. So here in part one of this video, we'll be talking about introduction to liquidity. Introduction to liquidity. Now we have that from what I wrote here. We have that. Let me bring in this out. From what I wrote here, we say that liquidity are key zones where enough money can be found. This money can be in form of pending orders or running position. That's the stop loss. So I'll be doing some explanation. Let me just bring in something for you. Yeah, I want you to understand everything I'm doing. So I'll be using diagrams too to explain. So let's just say we have a chart like this. This is a bearish market like this. And looking at this picture of this schematic diagram, looking at this picture of this schematic diagram, you can see that this price is bearish. And for those of you using different kinds of strategy, let's just say supply and demand strategy, and at every point in this supply level, you're expecting price to come to your supply level as to mitigate your supply zone. Most of you using ICT concept will call it the order block entry model, so as to get down with the trend. And for some reason, this is what you see happening in the chart here. You have your limit order set in place just because you might not really be around when price is going to do the retracement back to the order block or your supply level. So you have your sell orders here, and this is your stop loss. You'll be targeting this old low, that's like a liquidity, and this order block is your um take profit level. Let me just increase it. Your take profit level. So sometimes you can come to your screen and you see something like this. Instead of having a smooth running price, you will then see something happening in your chart like this, where price will hit your stop loss and still go in your full direction. This process of mitigating your stop loss is the sweep in liquidity. Price have collected your money, which is the which is the pending order. Then for the running position kind of sweeping liquidity, you can also see something like this. Let's just say you're a swing trader and you still have enough targets to meet here, down here, and because you're a swing trader, you want to allow your trade to play. Then you see how price will then do something like this in the same running position. Price will just retrace, keep retracing until it takes out your liquidity from here, hitting your stop loss, then going back in full like this, hitting your stop loss, then going back in full, hitting your stop loss, then you can see how price then deliver in full down to your take profit. So this is another way of taking out liquidity. This one is if you're in a pending order, then you have your order set. Then this one will not be when you're in a running position. Let me just go to my MetaTrader 5 and show you something like this. Okay, let's just say you're a trader and you're actually using this supply zone here as a point of interest, and you want to start trading when price gets into this level here, into this your point of interest. Some people will call it an order block. Now this is what you're going to do. Of course, you will just come to the market, you have your limit order set here, you want to see price retrace here, then your stop loss is going to be exactly above this high, this high here, this high here. So you don't want to see anything happen to that high. Then you now have your take profit to be here, or let's use this low. Now see what happened here. As for the pending other kind of liquidity, I'm telling you, this is just what used to happen in the market. Forget that you're seeing everything happen as I'm explaining. So this is people in the market. These are set of traders trading supply and demand. So as at this retracement, they were expecting a sell from this level, from this other block, from that supply level down to the next liquidity. But this is what price did here. Price actually reacted a little. If I should zoom in, let me zoom in, let you see. You can see the sell candlestick here. Price actually reacted a little. So after the reaction around this level here, price later traded above this good high. So people that had their pending order like this will get stop out around this very level. So this process here is the sweep of liquidity, where price swept liquidity above this good high. And from here now, we'll be expecting a drop in price. But price did not actually drop here because it's actually seeking for more liquidities, because price cannot actually go to its final direction without having enough liquidity to pull the price down to its final direction. Liquidity is just like the petrol that move price, so it's the main aim of price. The algorithm is programmed to go for liquidity, that's making money both ways. So before we can get to this old low, which is a liquidity, price have to create more liquidity in order to be able to push down. And this is what happened now. After taking out liquidity here, most people entered from this very level. Most people enter from this very level. Then this is what price did. It took out liquidity again above here. Took out liquidity again above here. Above here. Look at here. So price took out liquidity one, liquidity two. So you have more traders to enter around here. And I also say liquidity are places where price have not traded into in a very long time. In a very long time. Then if you see this one is more like a type of liquidity, which is this trend line liquidity. If you look at this place here, price constructed this liquidity from here down to here. You see that price have not traded above this level in a very long time. And this is what price did here. Price went inside here, traded to this very zone, took out all the liquidity, and this was the liquidity that price gradually built. That's why it's called engineered liquidity or constructed liquidity. So price built this liquidity, and after sweeping this whole liquidity, price had the momentum now to go to the overall objective, which was going for this other liquidity. So that's just it. Price does not actually move when there is no liquidity, and it always goes to where it finds more liquidity in order to be able to make money in the market. So the next place this price is going to come to is this zone here, where we have these lows here that have not been traded into for a very very long time. So this is where price is coming to. Then you can now see it might now construct another liquidity within this range in order to make money. That's just the whole aim of the algorithm, to make liquidity while taking out liquidity at the same time. So let me show you something here using this example. Let's just say this is a bearish market scenario and we have that price constructed liquidity here. So we are happily waiting for price to take out this engineered liquidity or this constructed liquidity, and you can see we've been creating lower lows, lower lows. So we are very sure that this market is bearish, number one, and for some reason price went up here, took out this whole level, traded into this whole level of liquidity, because I told you liquidity is a level where price have not been traded to. Most liquidity are found in that level. And you see now, so because we've seen that price have cleared all this constructed liquidity, we are going to enter this market right here, right here. Then our stop loss will not be around this low. Now we've entered the market. See what happened. I want to explain to you this. Everything I'm showing you here is happening for real, because you might not really understand until we have a live session trade or something that will show you in the chat. So this is it here. This is what happened after the sweeping liquidity. After the sweeping liquidity, I took this trade from here because I'm very sure that liquidity has been swept. So I believe price has gained its petrol, like I called it, to move down to this old level of liquidity, which is the old low. Because I told you liquidity could be found in old highs or old low. So why I'm in this trade? For some reason, price have found enough liquidity around this high. This is a very old time high that it did not get to. Now this is tricky. Price could go to this old time high at once. Let me show you. Price could actually run into this old time high from here. Let me unlock this. Price could actually run into this old time high at once while it's clearing this constructed liquidity. It could actually run into this old time high, taking out all the liquidity. But price did not completely do that because it wants to build more liquidity while it is actually taking liquidity, so it can actually have enough traders to liquidate. So now price took out the liquidity down to this level and people entered trusting that this high, let me go back, let me reverse. Okay, so look, so price did not actually go to this old high. So people have already trusted that price is going to deliver fully because it has taken a amount of liquidity needed to push down to a particular level. And you now see the reverse again. Price actually reverse, taking out liquidity from here and liquidity from here, which is that is going to be very very massive because after the fake out or the fake sweep of liquidity, or it's just this mind game that the algorithm do to actually lure people in the market. So price took out the current liquidity here and here, so it has taken out all of this liquidity here, mitigating your stop loss, and is now going to deliver in full to your take profit. So that's just it. And the same thing for a bearish or a bullish market. You can just see that this will be a liquidity that you need to go up. This will be a liquidity that you need to go up from this old low. Maybe you just want to, retrace inside price, and you see that price will now do something like this from this level. Do something like this, pushing, come down, pushing, and even stop and do something like this, then push to your final target. Push to your final target. So things like this used to happen. Now, this is where price took out the final liquidity. This is where price took out the final liquidity. So in cases like this, you must have already entered this market from here. You'll be longing from here because you feel like this was where liquidity was being swept. So after this push, you'll be so happy and you don't enter your market from here, hoping for the next liquidity, which is this old high. Then your stop loss is now going to be below this other level of liquidity that price took out here. Then you now see how price is going to mitigate your liquidity around this low. Price is going to mitigate your liquidity around this low and push forward. So these are something that I've seen, I've experienced it, and I know that yes, this is what price normally do in the market, just to build liquidity while sweeping liquidity. There are many examples, but I don't know if that would be on the normal identification of liquidity. Let me see if I can check out for two of these. Okay, you've seen there are many examples. There are many examples. I don't know if I actually have one or two examples here. Let me check. Let me check other pairs here. Okay, in this example here, I had here to be my overall liquidity. This old high, sorry, this old high to be my overall liquidity. So this old high was my overall liquidity, and this was my point of interest. And before this liquidity, I had places in the market that I was also looking out for, and you can see that this is quite this is a liquidity here that price swept. Let me zoom in so you can see. This is a liquidity that price swept from here. Price swept this liquidity, and I saw this shift in market structure, and price retraced into. I entered this market because I had a sweeping liquidity. I have a confirmation that price is actually going to move bearish, but this is what happened. Price took out this liquidity here second time. So this is why I used to say that losses are inevitable in the market because price is actually going to perform based on what is being programmed to do. So price actually took out my stop loss the first time, and after taking out my stop loss, I was still looking out for this trade to give me a good setup again from this level. Then I saw price going up. Okay, I was not feeling like price is heading for the overall TP, which is this, sorry, the overall liquidity, which was that very old high I drew here. See this very old high. So I was feeling like it's going to head for the overall liquidity before I take the second entry. And if you see, price did not really get to the overall stop loss. Then I saw a second confirmation, which was around here. Which was around here. this low where we had a shift in market structure, then that was how I was able to enter this trade from this imbalance. And we can see what happened. Price deliver? Let me check. Because yes, price delivered down to the last to the next liquidity level, which was this liquidity here. Price delivered to this liquidity level. And we see after taking out liquidity, price quickly reversed. So you need to understand that price is always programmed to go to where there are enough liquidity in the market. So liquidity can be around the old highs and the old lows. So price took out this liquidity, this very old low here, this very old low. Now it did not take out this one completely. Maybe it's leaving the liquidity here for future purpose. Then took out this very one here. That was how price left this area. Price left that area. So price left that area from there and it pushed up. Now, where do you think it's going to go for? It's going to go for the next area of liquidity. Now, you know that price have left. Sorry, this is why I say price always. This is what I say that price always build liquidity. Why is sweeping liquidity? So he swept liquidity here and he left this one. He left this one. He also left liquidity around here because the overall aim is for price to come down to the last bus stop, which is this is the final liquidity. This is the final liquidity here. This was actually the final liquidity. This low was actually the final liquidity, but price did not really go to the final liquidity. It was actually building this liquidity for future purpose because it knows that very soon it's going to go back to that place to take out this liquidity. So see what happened. Where the price now go for? It went for the other liquidity. It's snubbed too. Now the liquidity here is enough, so price actually headed or pushed for the north for this normal liquidity, this next liquidity. It's not at this level. We went for this liquidity here. Then you see how we reversed a little bit, and we knew we had a shift in market structure, and this is price actually coming down to the overall liquidity level. So he went for this one. He went for this one. Is not. Did he take out this one too? He did take out this one. So he went for this one and he took out the liquidity above this old highs too. So by this time now there were enough liquidity around these highs. Around these highs. So there were enough liquidity around this high and there was enough liquidity to around this high to push this price down to this low. So it's just like going for um price to fill up your tank fully. Took out liquidity here, took out liquidity here, and it pushed down like very massive. The push was very massive. So that's it. Why it was creating liquidity, it was actually sweeping liquidity too. It swept liquidity around here. It left this one, it created this one, and it created this one too. Created this two liquidity, then he also left this other low, this second low, and this other low to actually right before pushing it completely. So price um is actually programmed to build liquidity while sweeping liquidity because the whole aim of price action is to go to where there is liquidity. Price cannot be trading up just like this. It must actually build liquidity while trading something like this. Build liquidity, then take it out, go up, come down, build liquidity, take it out, come down, take out everything, continue going just in that session. Now, as it's doing is this is what it has done. It has actually built liquidity in this high. It has liquidity in this high. Then it took out the liquidity here, traded for liquidity below this low, which made it pushed up. He's supposed to go for this liquidity, but he snubbed it. Now people must start selling from here. They have their stop loss around their liquidity entered. Second entry will be here, and you see people will now rush to enter here, aiming the next level of liquidity, which is this low. But price did not start dropping from here. That's the dilution in price action. You went to took out this one, you did not take out this one. So you have liquidity here, you have liquidity here, people that sold down here, and people that are selling together here. So there's enough liquidity around these two levels. Enough liquidity around these two levels. So when price came, this is what it did here. This is what price did here. This is what price did here. Took out liquidity here. Took out this liquidity. And what did he do? He did not take out this one. He did not take out this one. He did not take out this one. So when you see something like this, especially a double top, just know that price is going to come back to that place, because this is where you have massive liquidity. Massive liquidity in the sense that this is like a magnetic pull around this. I'm seriously telling you the truth, because there's no time you have a double top and you see price really snub that level. So imagine the first set of traders, they have their stop loss above this high, entered here, took out all this liquidity. Second set of traders entered here, price pushed a little bit, took out liquidity, and you have another third round of traders that are in this market here. So you have liquidity here, you have liquidity here. Then this is now what price will do. Price will not continue like this, pretend like it's not after the liquidity, make people create more liquidity, like make people fall for more liquidity, go take this liquidity out, then drop it, then push, go create more liquidity, then you now have something like this. It's not going to push it down. So you looking at this now, you'll be like, oh, this is a very strong level. Now price have built more liquidity. I'm going to show you an example. Price have built more liquidity here again, adding up to the liquidity that is above this other high. This is more liquidity that price is building. So you have liquidity here, you have liquidity here, you have liquidity here also. So now you can see that you have liquidity above these three highs. Then this is what you get. This is what you get. Price is going to also push again, push again. Something like this, maybe make you feel like you want to be in this trade, then run up, run up massively above everything. When it runs up above all the liquidity, I think this is where we have the highest liquidity. This high. When it runs up above all this liquidity, you then see the final push downwards. From that level, you will now have a very massive shift or push to the downside. This is the push price needed. And now, look at what is going on. Look at what is going on. Let me check 3 hours. I want you guys to see something. Look at what is going on in this chart, guys. Why price is building liquidity up is also building liquidity down, building liquidity both sides of the market. Let's just say the first one, it took it out. So liquidity was swept the first time below here. That was what gave rise to this momentum, this push here. That was what gave rise to this push, which made price go up to this level because of liquidity is a fail, and it created liquidity around this low. So you now have liquidity around this low. So the most recent liquidity you have in the market is below here, below here, and below here, and below here. Because here liquidity was being swept here. Liquidity was swept here. Liquidity was swept here. So you have liquidity here. Sorry guys. You have liquidity around here. So this liquidity is what we have here. We have liquidity here. So there are enough liquidity on the downside. So we now have both buy side and sell side liquidity. So you see what happened now. After price must have built liquidity. Let me show you something. Let me show you something. Let me take this two out now. Now you see that if you look at this market now, price have built liquidity on both sides, and it has both of them to take out. So where is it going to go for? It's going to go for the closest liquidity. So price have all this liquidity from this high and this high, and you also have liquidity from this low and this low. So price is now going to go for the closest liquidity, which will be the high. I have not taken out liquidity in a very long time because the liquidity is from a very far place, which is this sorry, let me take this arrow out again. Price is going to go for the most liquidity level and the closest one. Now we have liquidity down from this range, so we have enough liquidity around here and here. But you see, price took out liquidity from this low. So where is it going to go for? It's going to go for the place that have the most money, which is going here. Then when it goes there, it's going to come back here to take out everything. That is how we see. That's how price do behave. Let me check one example. I think that's card CHF. Oh, sorry. So it was the example I'm looking for is on AUD card. So let me explain. Look at this massive drop in market. Then let me quickly zoom into this level here where we have this whole stuff I was explaining. the kind of consolidating or the kind of way market will build liquidity. So look at, just follow me. We have that this was the last place price traded into. This double top, I told you double top is very, very magnetic. You always drop price because we have liquidity around this high. We have liquidity around this high. We have liquidity around this high. So price without liquidity, you know. Now this is what it did. Yeah, this place that took out liquidity left this low. This is the last place that liquidity was taken after it took out this liquidity. So this low now, there was no liquidity around. There were enough liquidity around this low because people that are buying to a very level, they are going to buy to this other top because after you must have taken out liquidity from this high, you're actually going to start buying from this low. So it left liquidity here. Now, this place is supposed to come and take out this liquidity. It did not. So it pushed up again. And so for some reason, some people sold from here and sold down to here. So price did not take out this overall liquidity. So liquidity is being built below here, massive liquidity, because for every opportunity it gives for a buy, liquidity is going to be placed here or here. That's the stop loss. So this is the second entry also. So more liquidity are being piled up here. So I'm just increasing the volume of this rectangle to make you know that. Okay, let me explain again. This is the size of liquidity that was here as at the first entry from here to here, from here to here. So price dropped down. Instead of you to take out this liquidity, it did not. It reacted to some levels are inside there, and traders entered from here. Traders entered from here, and they've joined their stop loss to the previous one, increasing the size of the stop loss. Now I'm increasing the size. Now, people that bought here have their stop loss to be below this other block because they want it to be a very strong price, and they bought down to this level and it came down again. People saw this like a double bottom, those that use it, all this chart pattern, and they saw it to be a good one. And this third set of traders enter this market, yeah, still having their stop loss around there, which will now increase the size of the stop loss to this size because the stop loss is for 1, 2, 3. Still going, still going. Price came back here. Price came back here. Price came back here. The same scenario. People that sold from here have their stop loss to be above here, which made the liquidity left liquidity on this high here, and people also sold from here, left their liquidity above this high. So we are increasing the liquidity. This is just like a logical drawing of how price creates liquidity both sides. So people entered from here again, increase their stop loss. That is it now. From here, you have your stop loss below here. So we have liquidity around this low and this low, which is increasing the size of this stop loss. Enough stop loss is here, and this is what happened. People is selling again from here, increasing the liquidity level above this high. So it's actually increasing too, increasing. I hope you're getting the explanation. Then you can see price ran into this liquidity. So price mitigated this liquidity, took out all the stop loss. So it took out all the stop loss. So after taking out all the stop loss, yeah, let me delete it now because there's no liquidity here. A lot of people must have entered this trade from here because price is bullish or it looks bullish somehow. Not everybody knows the price direction. Let me zoom in again. So we now have a lot of new traders. We will now have a lot of new traders buying this market from this point here. From this point here. So they have their stop loss around here. Then price came back. I want you to understand something. Price came back. When you have a little retracement and a buy, this is the little retracement price did to the downside. And people entered, maybe have their stop loss around here too. Have their stop loss increased again around there. And price bought. And see what happened. Price also cleared out all the liquidity above this high, took out all of it. And see what it did. It dropped massively. It dropped massively down. It also took out all the liquidity below. Took out all the liquidity above and below also. So if you see on the 4 hours what it looks like, this is a run in liquidity from here for this very long time. Price have not traded above here, so you can see how massive price swept liquidity. You can see how massively price swept liquidity above. So price actually created liquidity here on the both side, just like I explained in that diagram. Liquidity from this level, liquidity from this level. That's it, guys. I think this is where I will stop part one. I've taken a lot of time introducing liquidity and showing you examples, so the other part will not really take this long. So like I said, I'm going to have a playlist for this liquidity topic. Then you just have to watch them on bit by bit based on the chapters in the sequence on how they come. So please, if you are watching this video for the first time and you want to get more interesting videos on ICT and under forex trading, do have to subscribe and follow for more videos. Thank you for watching to the end.